Hi, today we will learn how to use the Binance Exchange Arbitrage bots together. This video is probably the most comprehensive beginner's guide to Binance Arbitrage bots on YouTube. As long as you watch this video to the end, I guarantee you will understand it right away and be able to use it easily. It is very simple. Hello everyone, welcome back to my channel. Today I will show you how to use Binance Arbitrage bot to earn money without risk. What is the principle behind the Binance Arbitrage bot? What profits are we making? What is the perpetual contract? What is the funding rates for perpetual contracts? I will also share my own experiences using the bots. Let's get started. So first, what is the Binance Arbitrage bot? So for here, open your Binance account and move your mouse to Train and click on Trading Bots. Once you are in Clean Trading Out, then you will see the options for Arbitrage bots. Click on it. So for here, if you don't have a Binance account yet, feel free to scan the QR code on the screen or use the link in the video description to register. This way, you can permanently enjoy a 20% discount on trading fees, which is very important for making money with Arbitrage bot. Then now, let's first understand what an Arbitrage bot is. Let's look at the nature of Arbitrage bots. So it is a way to achieve a delta equals zero by holding a spot positions and short perpetual contract, or by selling it with a long perpetual contract, and then arbitrating the funding rates profits with no rates or lower rates. So what is delta equals zeros? Delta equals zero is that regardless of how the hedge price changes, my account's net assets volumes does not change. And if the hedge price increases, the spot positions makes money and the perpetual contract loses money. Then equals no loss and no gains. And on the other hand, if the hedge price goes down, the spot positions lose money and the perpetual contract makes money. Also, it equals no loss and no gains. Then, for example, like if Joe holds 1 Bitcoin in the spot market and shorts 1 in perpetual contracts. So in this case, his delta is 1 minus 1 equals 0. So no matter how the hedge price fluctuates, he will not experience a loss or gains. And another example, if Joe holds 2 Bitcoins in spot market and shorts 1 Bitcoin in perpetual contracts, his delta is 2 minus 1 equals 1. So he will profit when the price goes up and lose when the price goes down. So on the arbitrage page, you can see the current funding rate is 0.01%. But what exactly is the funding rate, and why does it exist, and how can it be used to make money through arbitrage? So first, let's understand what is perpetual contracts. So what is the perpetual contract? So there are two types of future contracts, which are traditional future contracts and cryptocurrency perpetual contracts. So what is the difference? A traditional future contract is a derivative financial instrument with unit trading pairs influenced by supply and demand, which establish its price. So in traditional future markets, such as contracts involve an agreement to buy or sell an asset at a predetermined price on a specific date. So these contracts typically use a daily settlement process where gains or losses are credited or debited to the trader's account based on comparing the closing market price and the previous day settlement price. This ensures adequate margin coverage for potential losses and provides the arbitrage opportunities to keep the contract price aligned with the spot market price or the underlying assets. And conversely, the crypto markets operated around clock. So for instance, like Binance offer perpetual contracts which at the same address have no expiration date, while various supplies and demand dynamic determine derivative pricing. The absence of a closing market and transparent settlement price eliminates traditional arbitrage opportunities. Since perpetual contracts does not follow the traditional settlement methods, exchanges use the funding rates to ensure contracts price periodically aligns with index price. So in this case, funding rate is a fee exchange between traders holding long and short position within their intervals, usually every 8 hours. So this fee adjustment help regulate price, ensuring that contract and index price converge periodically. Unlike traditional settlements, perpetual contracts use this funding rate mechanism to minimize the price discrepancies. So in summary, traditional future contracts has an expiry date and are settled at a spot price upon expiry. Therefore, the spot and future price will converge on the expiry date. And cryptocurrency perpetual contracts, on the other hand, never have an expiry date. The funding rate mechanism is used to prevent the spot price and the future price from deviating too far from each other. So the funding fees equals funding rate times nominal precision value, where the funding rate is a periodic rate. This can be positive or negative, determined by the price difference between the contract and the spot markets. And the nominal precision value is the size of the open contract position. The funding rate consists of interest rate and the premiums, which vary based on the price difference between the perpetual contracts and the market price. Understanding the dynamics of funding rates is crucial as they directly impact traders' profits and losses. High funding fees can erode maintenance margins, potentially leading to forced liquidations, and the purpose of the funding fee is to keep the contract price aligned with the spot price. So now we need to understand the rules on funding rates for perpetual contracts. First, the funding rate of the perpetual contract is charged every 8 hours, and when there are more long positions than short positions, the funding rate is is positive, this means traders with long positions pay those with short positions. However, when the funding rate is negative, when there are more short than long positions, this means traders with short positions pay those with long positions. So now we understand what is the funding rate. Then we will go for how to make money with Binance Arbitrage bots and what kind of money we made. So still, for example, if a trader Joe holds 1 Bitcoin in the spot market and show 1 Bitcoin in perpetual contracts and his net position delta is neutral, 1 Bitcoin spot minus 1 Bitcoin short equals 0. So for this case, John earns money if the funding rate is positive because long side pays the short side. And conversely, if Joe sells Bitcoins in the spot market and goes long 1 Bitcoin in the perpetual contracts, his net positions is again neutral. So minus 1 Bitcoin spot plus 1 Bitcoin short equals 0. So in this case, John earns money if the funding rate is negative because short side pays the long side. So then we may have a question. So why do we sometimes lose money? The losses occurs when transaction fees expense is his funding rate profit. So for loss, spot transaction fees plus perpetual contract fees equals expensive and greater than funding rate income in this case. So you will have a loss. And on the other hand, you will have profits when the spot transaction fee plus perpetual contract fee equals expense and smaller than funding rate income, then you will make profit. So in conclusion, minimize transaction fee is crucial to maximizing profits using the arbitrage bots. We recommend registering with Binance using the QR code on the screen or link in the video description to enjoy the permanent 20% fee discount. This discount is essential for profitability when using the arbitrage bots. In the arbitrage bot page, you can see this session shows that the arbitrage bots are divided into USDS and arbitrage and coin-based arbitrage. So what do these terms mean? So first, for the USDS and future contracts, it is a perpetual contract. Using USDT or USDC as collateral allows you to go long or short on any cryptocurrency with USDT at the margins. This means you can trade various cryptocurrencies without owning them using USDT to secure your positions. And since USDT or USDC is a stablecoin pegged to the US dollar, its value does not fluctuate significantly. This means that USDT stability reduces the rates associated with sudden price changes, making it easier to predict profits and losses. And last, when you profit from the perpetual contracts, your gains are in USDT. Conversely, when you incur losses, they are also in USDT. So this means that your financial results, gain or losses, are always in USDT, simplifying accounting and value tracking. What is coin and futures? So a coin and future using a cryptocurrency as collateral, meaning you can only trade perpetual contracts of the cryptocurrency you hold as margins. For example, if you use Bitcoin as margin, you can only trade Bitcoin perpetual contracts. So you need to own the specific cryptocurrency you want to use for trading, limiting your flexibility compared to USDS and futures. And also, the value of margin itself can change due to cryptocurrency price fluctuations. Since cryptocurrencies can be very volatile, the amount of collateral you need can change, adding another layer of risk. And last, when you profit from the coin and future contracts, your gains are in the cryptocurrency used as collateral. Similarly, losses are also in that cryptocurrency. So your profits or losses will be based on the cryptocurrency used, which could appreciate or depreciate in values, affecting your overall financial positions. So next, back to arbitrage bots, we can see that there is positive carry and reverse carry options. So what do these terms mean? So first, positive carry. This is when the carry is positive and the strategy involves shorting a perpetual contract to earn the carry and buying the spot asset to hedge against price change. In this case, you borrow cryptocurrency to sell it at a high price and then repurchase it at a lower price. At the same time, you buy the actual cryptocurrency to protect yourself against price change. This way, you earn from the difference between the selling and buying price. And next, reverse carry. So reverse carries is when the margin is negative. This strategy involves going long on the perpetual contracts to earn the carry and shorting the spot asset to hedge against price change. So for here, you buy cryptocurrency at a low price, hoping it will go up and sell it at a higher price. At the same time, you sell the actual cryptocurrency to protect yourself against price drop. So this way, you earn from the increase in the cryptocurrency's values. So finally, let's open the trades using the arbitrage bot. And here is what you need to know. So first, when you're in this page, you can see Binance allow two types of trades, which is positive carried, reverse carried. So as I explained before, positive carried is the common type that most people use, and we buy in the small markets and take a sensitive short position in the future markets, getting paid on that short positions. And most people use positive carry because funding is usually positive, although there are times when it is negative, it is mostly positive, making this trade popular. So reverse carry is different. You already have the crypto assets and sell it in the spot market to raise cash. Then you go long in the future markets. While it can work, it is not commonly done. This method involving longing for the assets in the future market and earning funding from the short sellers. However, most people just prefer the positive carry trades since funding is mostly positive and yielding better returns overall. So we can choose any assets for these strategies, and the key is that it reliably pays the decent yields from the funding. So from here, you can see the annual percentage rate or funding rates are ranking in descending order. So how do we choose assets with the high APR? So you can just sort by APR to filter out the ones with a high APR, for example, like here. And by the way, for here, which is USDS and coin and future, you can choose from. And in this session, we can see the trading pair available for arbitrage. So among all the assets, Bitcoin, Ethereum, and SOT have the best liquidity. So beginners should choose from these rates. And then let's look at the middle area. So in the top of it is the arbitrage hedge and its information. We can see there is spread rate and 3 days funding APRs and 7 days funding APRs. So this is all the information you can know from here. And the middle of it is the K-line charge area. And the below of it is 40 days funding risk curve, which is really important when you make the precision of it. And go to this area. So for here, you can see this contract using 2 times leverage. And then in this session, please remember that reverse carry is invested in cryptos and positive carry is invested in USDT or USDC. And next, let's create an order together. So first, let's choose Ethereum as example. As I said before, since Ethereum, Bitcoin, and SOL has the best liquidity, so we just choose here. So from here, we can see that these are the 2 sides of the order, but the asset choice isn't critical, so we can enter this page on the boat to start. From here, we are taking a short position in the future markets while buying in the spot markets. Binance use a bit of leverage, as we can see here, so we will use leverage on the short side. This is acceptable because they will use Ethereum on the future side as account liquidity. If the price rise, our long side wins and we get more account equities. The short side may lose, but we have more equity to find a trade. So with 2 times leverage, there are a race of liquidation if the price raises very quickly. If the short side gets liquidated, you will have the long positions creating a raise positions. However, if the both sides goes up in price, it shouldn't pose many issues. So we can see that the 3 days APR is 10.95%, and Binance use leverage here to allow you to invest more into the long trade, increasing the nominals of your positions. This way, you can earn 10% more than you have in cash to fund the trades. So from here, we can see that there may be a minimum amount required to invest. From here, which is 50 USDT. So you can just enter the amount you want to buy or just simply use the sliders. Then when you just finish, just pressing create will start the process. So for now, you will see all of your order information. When you confirm everything, just click on convert. When you just finish it, scroll down, you will see your order information in your running session and history session. We can see that there is a funding fee, but remember that the funding rate on Binance is exchanged between longs and shorts every 8 hours, so the trades must run for some time. As long as funding remains in our favors, we will receive it. If funding goes against us, it will reduce the potential yields. And then you don't need to manage both sides of the trade manually. If you want to end the trades, just press end and then click on choose sorts and confirm. So for here, it will close both sides of the trade for you. I hope you found this video helpful and don't forget to check the link to get the transaction fee discount. Enjoy your tradings and see you in the next one.